Welcome to Fisher Webinars. The following is a recording of Foreign Exchange, a disruptive force in the pulp and paper industry, originally recorded on Thursday, April 23, 2015.
Today we're going to talk about a potential disruptive force facing the pulp and paper industry in the volatility of currency valuations or foreign exchange rates. And let's kind of talk about a few things. There are a number of challenges and opportunities that are presented to our industry from these disruptive forces. But disruptive forces are not bad. I think sometimes people think of those as being bad things. At least they're not bad for everyone, right? So think about things like electricity, the automobile, internet, and so on. All of these were disruptive forces at one time. But can you imagine doing business today without them? So today we're just going to focus on one of those, as I mentioned, currency valuation and changes in currency valuation and the potential impact that we'll see from those. Now, this is a chart that I think kind of defines what financial types and economists refer to as a random walk of uncertainty. This is the percent change against the U.S. dollar of several foreign currencies, the Russian ruble, euro, and Brazilian currency, over time since 1999. And so you can see there's been an awful lot of volatility. So it's a very volatile, very uncertain pattern here. So good luck if your job is to predict how currencies are going to behave. No easy feat. So while we can't be certain of exactly how currencies are going to behave or when they're going to change, one thing we can be certain of is that changes in currency valuation will certainly be a disruptive force in our business. Now, I have this belief that banking on currency valuations can be kind of hazardous to your health. So here's a chart that shows the euro to US dollar exchange rate back at the time the euro was introduced and for the first couple of years after that. So you'll see the euro was introduced around this level, a little above $1.15 per euro, and then had a period of decline, but then kind of leveled off. So we got to a point in late 2000s, early 2001, and so that in this range of around 1.12 euros. So if you were a U.S. producer selling some product into the United States, every US dollar of sale that you generated, you got to take back home with you 1.12 euros. So you might say, all right, things seem to have leveled off here, so I kind of like this exchange rate. This seems to be a favorable environment for us, so maybe I'll add some capacity. Maybe I will expand my footprint at home to be able to take advantage of this so I can export more products to the United States. Well, oops. So what this chart shows is the rest of that behavior of the euro to US dollar exchange rate. So here's what I just showed you, this part of the curve. Now this is the rest of it up to today. So here what we see is that you were this person, this company selling in this period of time, getting $1 and 1.12 euros for every dollar of sale. A few years later, you were getting about 60% as much. So you were selling the same amount of volume, but because of currency fluctuation, you were only being able to take home 60% as much money. So building capacity based on exchange rate seems to me to be a fairly risky proposition. But what if I already have excess capacity? Well, let's take a look at what I'll call Exhibit A, the European coated free sheet market. Now, some of you have heard me talk about this before, or we've written about this. This is a market that is, I think, a very interesting market because of the dynamics here. So this is a market share chart of coated wood-free, coated free sheet production in Europe. And what you can see here is that this is a very fragmented market. There's no one that we could call a clear market leader. And so when you have a fragmented market like this, we see things typically such as very fierce competition, which is certainly evident here. In this space, operating rates have been stuck in the 80s for many years, so there's an awful lot of excess capacity in the coated wood-free market in Europe. Now this just gives us a little bit longer term view of what's been going on in that market over time. So here we see that the market for coated free sheet, coated wood-free in Europe has been in decline. Now this chart represents just coated free sheet producers that are members of CEPI, and there's 14 or 19 countries, I forget the exact number, but this represents their production over time, and you can see a steady decline. This is the same data, shows the same production volumes, but now we've split this into where the production is being sold. So the orange bars are domestic consumption, product that's being shipped within the CEPI organization or the CEPI union. The purple bars are products that are being exported. And so you can kind of see how that's changed, but I put this green trend line that really brings this home for you. So what we see is that in 1999, less than 5% of the coated free sheet production among CEPI members was being exported. In 2013, that number was over 30%. So what this tells us, or what we can infer from this chart, is that it seems that European coated free sheet producers have become more and more dependent on exports as their demand has fallen. So rather than take steps to reduce capacity to match declining demand in the domestic markets, Europe has sought another home for that output. But you know, if you have been a coated free sheet producer, say in North America or in the United States specifically, it might feel like all of that product has been coming to the U.S. But in fact, we know from some data sources that actually most of the exports from the CEPI countries were going to countries other than the United States. We'll talk a bit more about that in the next couple of slides. All right, so let's talk about the effect of exchange rates on cost and international trade. So this is a cost curve for European and North American producers of coated free sheet delivered to Chicago. So the idea is, what's it cost to put product in the center of the United States? And the exchange rate that I used here was sort of the prior 5-year average of about $1.35. The dollar really started strengthening around late summer of 2014. But prior to that, there had been this period where if you looked at that average, it was around $1.35. So that's the number that I used there. So what we see here is that during that period of time, or if we use that exchange rate today, that North American U.S. producers specifically had a pretty significant cost advantage against the European competitors. And there are a few reasons for that. First, just to begin with, there are lower costs for fiber and energy and labor, but that distance, sort of the Atlantic Ocean, provided some protection against a large volume of imports into the United States. But even in this, what seems like a fairly unfavorable environment that I just described, there was still coated free sheet product coming into the United States from Europe. So even here, European producers were shipping product to the United States. But in recent times, as the dollar has strengthened, as we've seen in the last 9 months to a year, those cost advantages have really started to disappear, or certainly started to erode a bit. Same chart, delivered, coated free sheet cost delivered to Chicago. And what you noticed is that these green bars now start to move to the left. So European producers are becoming more competitive. Now, here I set the exchange rate at $1.05, which is what it was when I produced this chart this morning. I believe it's around $1.07 in that range. So we see this sort of march leftward on the cost curve from European producers. But what happens if the dollar continues to strengthen and gets to some of those levels that I showed you on that initial chart? Let's say that the dollar continues to strengthen so that it gets to a point of about 90 cents per euro. What happens is European producers really take over the low-cost spaces on the cost curve for coated free sheet delivered to Chicago. Of course, the other thing that happens is U.S. producers move to the far end, far right of the cost curve, which makes them very vulnerable to price competition. But of course, you might say, well, European producers aren't going to ship all of their tons to the United States, and you'd be right. So what I did was sort of craft the cost curve and adjusted for that. I said, well, what happens if these European coated free sheet producers were to just ship 30% of their volume to the United States? Even there, we'll find that things are disruptive, because let's agree for the moment that demand in the U.S. for coated free sheet is just north of 4 million short tons, and we'll strike a line on here. Well, what that means is a problem, right, for everyone that's to the right of this demand line. They are sort of on the outside looking in. Again, if Europeans ship 30% of their production to the U.S., which would mean that they're currently, CEPI countries, as we showed, were already exporting more than that, but not all of it was coming to the United States. So this would, maybe even this is a little hard to get our minds around. So what if we just said that Europeans are going to ship 15% of their volume? What happens to the market if 15% of the production comes to the U.S.? Well, same chart, again, once I just adjusted the width of the green bars to be 15% of the productive capacity of the people who own that capacity. And if that happens, there are still demand is around a little over 4 million tons. There are still a number of U.S.-based companies that could potentially be on the outside looking in at their home market. Because again, remember, every ton of European or any country, I'm using Europe as an example now, but any ton of product brought into the United States displaces a ton that's produced domestically. The other thing that's important to remember is that operating rates are low in Europe, and so European producers certainly have extra incentive to fill that unused capacity. And the other thing that they might do is look to divert some exports going to other countries where maybe the exchange rates are not as favorable as they are in the U.S. So again, you pick the number, and you can do this sort of analysis to see what sort of impact various levels of imports into the U.S. could have on U.S. domestic producers. Now again, the key takeaway for some of this is that Europe's coated free sheet market, of course, is significantly out of balance. And that excess capacity always seeks a home. The low operating rates in Europe really provide extra incentive for European producers to look for opportunities to export. And as I mentioned before, that disruptive forces like currency changes aren't bad for everyone. If you're a European producer, this is a real opportunity, because exporting products not only provides incremental margin on those additional tons that you sell, but those additional tons then serve to raise operating rates, which of course then lead to improved market dynamics in Europe's home market. So this could be a really good thing for European producers. And of course that strong dollar really provides sort of a break or some relief from what have been pretty poor market dynamics in Europe, in the Europe coated wood-free market for quite some time. And an extended period of a strong U.S. dollar could force some of those higher cost U.S. producers completely out of the market. Okay, let's continue on and think about some other areas where foreign exchange can have an impact or be a disruptive force, because it doesn't just affect trade flows. Let's think about this from the perspective of, let's say you're a supplier selling something to the pulp and paper industry. Here I've chosen an easy example for us to get our mind around. I've chosen pulp, in this case NBSK pulp, because we have data on both sides of the equation, right? We know at Fisher, we know who's making the pulp and how much they're making, and we also know who's buying it and how much they're buying. So this pie chart shows the purchases of NBSK by region. So of the roughly 11 million metric tons of NBSK that's purchased in the world, about 3 million tons of that's purchased in Asia. The rest of it, almost all the rest of it, is purchased in North America and Europe. Of course, you know that all of it is made in North America and Europe. But keep this in mind, that so Asia is a big customer for pulp producers. And also, you know that pulp is a global commodity that's traded in US dollars. So let's take a look at a cost curve for those participants making NBSK pulp. Now I've set this again to be at that sort of $1.35 per euro exchange rate that we had experienced over that sort of the average of the prior 5 years before we started seeing the recent strengthening. And what you see here is clearly Canadian producers sort of ruled the world. They're the guys in the red bars here. So Canadians had a distinct cost advantage over the rest of the world in producing NBSK. And another note is I set this to be FOB the mill, so there's no freight involved here because we could ship this anywhere. The other thing that I've done on this chart is to set a reference line. In this case, I struck the reference line at the median cash cost, which is about $550 per metric ton. But you could set a reference line on this chart anywhere. You could pick a spot that you believe is the transaction price and set it there. But the point that I'm trying to make is I want to be able to have some constant that we can keep our eye on, and we'll see how margins change with a variety of foreign exchange scenarios. So this was at $1.35. But what we've seen happen as the US dollar has strengthened in recent months, at the same time the Russian ruble was declining rapidly, these purple bars, these are Russian producers, leapfrogged to the far left, to the low-cost position of NBSK producers. Again, these costs are expressed in US dollars. So the Russians really made big gains in their competitiveness here. But you can see all producers outside the U.S. saw their dollar cost of production to go down. So you'll notice that the headroom between the tops of the cost bars in this reference line starts to become more significant, right? So this means companies are making more margin. But what happens if that dollar-euro relationship, again, it's not just a euro in this chart, I should clarify. I also adjusted all of the other currencies for these producers of pulp accordingly. So I've been talking about the dollar-euro, but in this case I've adjusted all global currencies accordingly. So if the dollar reaches those 15-year highs against those other currencies, the dollar cost to produce NBSK just really plummet for everyone outside the United States. Again, the headroom is just increasing dramatically between the tops of the cost bars and this reference point that we had here. So that's the good news for everyone except producers in the U.S., because the producers in the U.S. are driven to the far end of the cost curve, which really makes them vulnerable. So everyone except those U.S. producers are going to see some extraordinarily high margins unless their customers say, wait a second, we want to participate in some of this windfall profit. So maybe the buyers of NBSK might start to wrestle a bit with their suppliers to force prices down because they know that the suppliers are making more money than they had previously. So let's review some of those disruptive impacts. And this is a great example here. So that if prices stay where they are, remain flat for NBSK, all producers outside the U.S. are going to win. There's going to be a big windfall. So for example, last year, every U.S. dollar of pulp the Canadian producer sold, they got to take home 0.77 Canadian dollars. Today, that same sale, they get to take home 0.88 Canadian dollars. So what's that? About a 15% increase in margin based solely on exchange rates. The other thing that could happen is that higher margins that we show that everyone could enjoy will most certainly attract new capacity. Aside from the wisdom of that, there could be some people that say, I want to get in this game. But the buyers of NBSK are also going to know that this phenomenon is happening, right? So they may begin to pressure their suppliers to lower prices as a way to sort of extract some of that excess profit from the market. And if that happens, if prices start to decline, those few U.S. producers who have been driven to the high end of the cost curve could potentially have some real problems. Their prices could be below their cost of production, and that's never a good thing. All right, well, let's move on to another area where currency valuation can have an impact on our business, and that is in the area of mergers and acquisitions. Let's just do a quick review. We talked a little bit about M&A activity several months ago in another webinar that we did, but just a quick review. We know, of course, that the value of any firm is tied to its ability to produce a growing stream of cash flows, right? But in flat or declining markets, like a number of pulp and paper markets are, where are those companies going to find that growth? Well, sometimes it's through M&A activity, and we've seen a fair amount of that, particularly in the United States recently. Capstone bought Longview, PCA at Boise, Rock-Tenn bought Simpson, Verso NewPage. Now, growth certainly wasn't the only factor behind some of these transactions, but it's always a factor. It's always something that companies think about. We have this Rock-Tenn Midwest-Vaco merger that's pending that's also in part about growth. So that we've seen a lot of this lately, but as markets become more consolidated, these deals start to become a little harder to find. Let's look at another example that I think is a good one that represents this. It's the North American uncoated free sheet market. So once again, this is just a market share chart of North American uncoated free sheet. And I would call this a relatively consolidated market. You see market leadership here. Domtar is clearly a leader in the market. And so while we would technically call this a relatively consolidated market, by no means am I suggesting that there's no possibility for further deals, because there certainly could be. But the point is that as markets become more and more consolidated, acquirers will face probably heavier regulatory burdens to consummate some of those deals. Going on with a look at the North American uncoated free sheet market, we see that these purple bars are productive capacity, and that's dropped considerably, actually about 6% per year over time. And I've also put on here Europeans uncoated free sheet production. This includes all of Europe. We've seen that market has actually gone down about 1%. So both markets are declining, but the European market is declining much less than the North American market. So if you are a U.S.-based uncoated free sheet producer, you looking for growth, you might say, well, Europe's market's not fantastic, but it's better than mine, so maybe I'll look to see if I can sell some more volume in Europe. But shipping product from the United States or from North America to Europe is going to be a little tough. Again, with the exchange rates for the euro and US dollar at that current level that I was using, about $1.05, you'll see that this cost curve of delivering copy paper to Berlin, there are some North American producers that are scattered throughout the cost curve, but many of them just wouldn't be competitive. And there's a pretty big gap between the low-cost producers, European low-cost producers of copy paper, and the first occasion of a North American producer. So it would be a little tough in current environments to export product to Europe to try to expand your footprint. But if you can't beat them, buy them. So let me explain this pie chart here. What I've done is I've taken all European uncoated freesheet production and divided it by the company's headquarter location. So 10% of the uncoated freesheet that's made in Europe is made on machines located in Europe that are owned by a company located in the United States. Okay? So that's the same for all of these countries here. So maybe a US-based company might try to capitalize on the current strength of the dollar to go acquire one of these European-based companies. Now, I've been talking a lot about the euro and the dollar. The dollar is strengthened against really all currencies, but its rise against the euro has been pretty significant. Here I just picked two, the euro and the British pound. So the euro, the dollar is up almost 30% against the euro in the last year or so. It's up against the British pound, but by a lesser amount. So let's just continue to focus our attention on these companies located in the Eurozone. So here's another chart that requires some explanation here. This is the production of uncoated freesheet split out by companies who are headquartered in the Eurozone. So each slice of the pie is a company headquartered in a country where the euro is the currency. So this just shows you the dynamic, the different size of those companies that are represented here. So the point is that with the dollar as strong as it has been, every one of these companies is essentially on sale. So again, maybe a US-based company might go shopping in Europe. And this chart kind of shows why they might be interested in doing that. So let's just imagine that one of those companies, this fictional company that's located in the Eurozone, has a market cap of €1 billion. Well, if I were a US-based company thinking of buying that firm at this time, back in 2008, 2009, I would have had to give the shareholders $1.6 billion in exchange for their €1 billion valued company. But of course today, the picture is much different. I could buy that same €1 billion market cap company for just a little over $1 billion. That's about a 35% discount. Pretty big deal. Now, of course, once companies would agree to that selling price and purchase price, the acquirer could hedge away their exposure to further currency volatility by using some hedges and some financial risk management tools. So let's wrap this up here. So we've seen that currency valuation certainly has a direct and sometimes immediate impact on pulp and paper producers. The euro has gone up 25% in a 9-month period and almost 30% during the past year. Or I'm sorry, it's gone down. The dollar has strengthened that much against the euro. And a strong dollar makes foreign goods cheaper to buy. But building capacity to capitalize on those export markets is pretty risky. Let me make another comment here about this, because I've been talking about, and my theme here was that a strong dollar makes foreign goods, and we've used the example of paper products, pulp and paper products, it makes those cheaper to buy. But it makes everything that's sold in foreign currency cheaper to buy. So for example, paper machine equipment, if there's a company in Europe that produces paper machine equipment and they sell it for whatever, €1 million, well, that US-based company could buy that €1 million piece of equipment for a lot fewer dollars today than they could 2 years ago. So it's not just the trade flow of products, it's other things as well. So again, that dollar makes all foreign goods cheaper to buy. But a strong dollar also makes foreign companies cheaper to buy. So maybe rather than taking the risk of building capacity, U.S. companies might buy capacity in another country using that strong dollar as an elevated currency to gain access to those new markets and provide enhanced growth opportunities. We've also shown that a strong dollar really provides a windfall to companies that are selling, to non-U.S. companies that are selling U.S. denominated goods like pulp. But there is certainly the potential that if the dollar remains strong, buyers of those products might start to wrestle their suppliers for some of those excess profits, which would have the effect of forcing prices down for those items. So we'll conclude here by just reminding us that the strong dollar really does pose a threat to U.S. producers of products that travel well. Probably not things like tissue and towel, but many other products that travel well poses a threat to them. The flip side of that poses a real opportunity to companies outside the U.S. to gain access to a big market. And the thing about it for U.S. producers, there's really nothing you can do about it. There's not much you can do to fend off the impact of the strong dollar. I don't know what that would be. However, you might not just sit idly by, because it does provide an opportunity for U.S. producers to go shopping in countries where the currency now is weaker against the dollar. All right,